To secure a lease on an apartment, finance a vehicle, or obtain a mortgage, under almost every single roof in modern America, an individual must navigate a highly structured gatekeeping system. While factors like income and debt-to-income ratios are critical, this three-digit metric serves as the primary screening mechanism used to determine who gets approved for capital and the exact price they will pay for it over several decades. A baseline assumption exists among borrowers that this system operates on a transparent, universally standardized mathematical formula. The traditional 300 to 850 scoring scale is presented as an absolute measurement of financial reliability, tracked through a simple breakdown of percentages. This chart shows the public-facing model distributed to consumers. Payment history dominates the calculation at 35. Looking at the remaining components of this model, the chart fills out with amounts owed, or credit utilization, taking up 30%. The length of credit history accounts for 15%. Finally, new credit inquiries and the overall credit mix, balancing revolving credit like cards with installment loans like mortgages, each take up 10%. But this specific pie chart, often found on educational websites and banking portals, does not exist inside institutional underwriting departments. The clean percentages are an approximation, a tool designed for public consumption. Behind that chart runs a guarded algorithmic architecture that rarely aligns with the simplistic math consumers are taught to follow. The result is a significant information asymmetry. Millions of individuals make long-term financial choices, closing old accounts, timing their debt payoffs, and applying for major loans based on an approximation of how their creditworthiness is actually being calculated. The algorithm responsible for calculating consumer creditworthiness is classified as a proprietary trade secret by the Fair Isaac Corporation. The exact mathematical weights, the specific penalty deductions for a late payment, and the precise variables used to generate the final number are opaque. No independent researcher, nor the consumers being judged, is allowed to audit the internal calculations. This chart shows the disparity between the two systems. On the left is the consumer-facing approximation. On the right is the institutional reality, an intricate, multi-layered risk assessment engine protected as a corporate asset. Lenders pay to access the output of this vault, while consumers are left to estimate its internal mechanics. The complexity extends beyond a single hidden formula. The Fair Isaac Corporation's architecture is not a singular FICO score. The proprietary formula has been iteratively updated, segmented, and specialized over decades, resulting in a landscape of competing algorithms operating simultaneously. Currently, lenders utilize a wide array of specialized scoring models. There is FICO 8, which is the most widely used baseline. There is the newer FICO 9, which treats medical debt and rental history differently. There are FICO auto scores, engineered to weigh past car payments more heavily, and FICO bank card scores, optimized to predict credit card default risk. Institutions deploy these specific versions based on the nature of the financial product. A credit card issuer wants to know the risk of revolving debt default, so they pull a bank card version. Mortgage lenders, following guidelines from Fannie Mae and Freddie Mac, are often required to pull older algorithmic versions, such as FICO 2, 4, or 5, which process financial data using logic formulated years ago. Because consumers rarely know which specific algorithmic version a lender is pulling, they enter negotiations with limited information. An individual might check a free monitoring application, see a score of 800 generated by FICO 8, and walk into a dealership expecting prime rates, only to receive a higher interest rate because the dealer pulled FICO Auto Score 5, which calculates risk differently. This map shows how the credit ecosystem operates. The architecture relies on the interaction of 5 distinct entities: the individual consumers, the lenders providing capital, the credit bureaus warehousing the data, monitoring companies providing interface apps, and the Fair Isaac Corporation itself. The cycle begins with the consumer generating data. Every time a bill is paid, a balance is carried, or an account is opened, that raw data is captured by lenders and forwarded to the 3 major credit bureaus: Equifax, Experian, and TransUnion. The credit bureaus do not generate the FICO score. They store the raw history. When an application is submitted, that raw data is forwarded into FICO's algorithmic engine. The specific FICO model processes the data, calculates the risk metric, and sends the final 3-digit score back to the lender to inform the underwriting decision. This architecture supports a secondary market. Consumers pay monthly subscription fees to monitoring companies for access to their data. Those monitoring companies, in turn, pay licensing fees to FICO for the right to display the score to the user. When we look at the data pipelines connecting the bureaus to FICO, structural flaws emerge. Regulatory reports from the Consumer Financial Protection Bureau show that millions of consumer credit files contain errors, ranging from mixed identities to outdated collections. The FICO algorithm assumes the data it receives is accurate. It will calculate a score based on inaccurate bureau data, instantly damaging a borrower's profile. Analyzing this map shows that the ecosystem operates as a risk mitigation and data commodification pipeline. It is designed by institutions to manage financial risk and generate profit, rather than acting as a public utility for individual financial tracking. A consumer entering the financial market navigates a system of hidden mathematical formulas, competing algorithmic versions, and layered corporate interests. This structure obscures an individual's financial standing behind proprietary walls, leaving borrowers to estimate their own viability. Operating within this environment requires a shift to an active defensive strategy. By acknowledging the mechanics of the system, borrowers can stop reacting to approximations and start managing the data pipelines that dictate their rates. The first requirement is acknowledging the multi-version reality. Checking a single educational score is insufficient. Before applying for major credit, consumers should obtain disclosures that show the specific variations of their FICO scores, including FICO 8, 9, and the industry-specific models, to see the same metrics the underwriters will use. The second step involves precise alignment. A borrower should anticipate the algorithm based on the capital they are seeking. If applying for a mortgage, attention must be directed toward the older models required by federal underwriters. By aligning the loan type with the corresponding version, consumers reduce the risk of unexpected terms at the negotiation table. The third defensive measure occurs before the algorithmic process begins. Because FICO calculates whatever raw data it receives, discrepancies must be disputed directly at the credit bureau level. By correcting the raw feed at Equifax, Experian, or TransUnion, the data is adjusted before it ever enters the FICO processing engine. The internal mechanics of the Fair Isaac Corporation are protected as proprietary secrets. However, by mapping the pipelines, verifying the raw data, and understanding which algorithm is applied, consumers can successfully navigate the architecture and protect their financial interests.